Howdy, everybody. So the next thing that we're going to talk about, the next current asset that we're going to concern ourselves with is the inventory account. There's going to be two modules to this chapter, and we're going to first look at what goes into the inventory account, what value-related items do we want to include in inventory, and how do we want to keep track of inventory. We're going to notice that there are two ways to track the inventory system, a periodic system or a perpetual system. And we're going to talk about special transactions that may or may not represent changes in inventory and or sales associated with the changes in inventory. So let's start off with a real basic definition that inventory is representative of assets that are held for the sale in the ordinary course of business, or goods that will be used in the production of goods to be sold. And so here we have, of course, goods held for sale in the ordinary course of business. This would be, for example, a retail firm. Goods that will be used in the production of goods to be sold would be more along the lines of a manufacturer. These are the two main types of firms, retail and manufacturer, that will have inventory on their balance sheet. For a merchandising retail firm, they will have merchandise inventory, obviously. For a manufacturing firm, they'll have raw materials, work in process, and finished goods, which is a more detailed separation of what's going on in the inventory balance. And so they'll have actually different accounts, a raw material account, a WIP account, and a finished goods account. But then each of them would be a representation of inventory to a manufacturing firm. They would all be debit balance accounts and hence increased with debits. Also, we've talked about long-term contract firms. And if you're a construction firm or a firm that undertakes long-term contracts, remember that the construction in progress account could be a contract asset or a contract liability, dependent upon, of course, construction in progress and billings. So as I said or mentioned before, there are two types of inventory systems. We have a perpetual system and a periodic system. The perpetual system is continuously updated, hence perpetually updated. The periodic system is only changed at the end of an accounting period when we take a physical count of inventory and then we make one adjustment to find cost of goods sold. So let's look a little bit closer at the perpetual system. This is most likely the system that was taught to you in Intro to Financial, at least it was to me, because it's a simplified system. We don't have a lot of accounts in there. Any purchases or in the production of any finished goods are just put into an inventory account, and then sales are debited directly from this account. And so there's just the inventory account. We debit it when we purchase inventory, we credit it when we sell it. Under a perpetual system, as I said, it's continuously updated, so the balance of cost of goods sold should give us an accurate running total at any point in time. We will know precisely at this date what our cost of goods sold figure is. That's going to be in opposition to a periodic system where we do not have a cost of goods sold until the end of the period. At the end of a period in a perpetual system, we do still take an inventory physical count. We do that under both systems. The advantage of a perpetual system is, since you know how much COGS you should have, when you count up the inventory at the end of the period, any discrepancy between what you know you should have on hand and what you don't have would be defined as a loss on inventory. It would be theft, spoilage, shrinkage. Sometimes this is actually called inventory shrinkage, which is just a term for an amount of inventory that is lower than expected. Okay. So under the perpetual system, we can get a estimate of what we know has been sold because we're perpetually updating it, and then we can compare that to what we have on hand at the end of the period. A periodic inventory system has a lot of accounts. Instead of actually recording purchases in the inventory account, we record the purchases in a purchases account. The purchases account is a nominal account and an adjunct account. So this is going to increase the balance of my inventory account. At the time of sale under a periodic system, we do not record cost of goods sold. We wait until the end of the period, we count the ending inventory, and then we use that count to mathematically determine what our cost of goods sold for the period was. And so, for example, if we start with beginning inventory for a period, we would then add to beginning inventory any purchases we've made. And so this will actually be net purchases, and we're going to see what that it consists of in a moment. So if I start with what I had at the beginning of the period, I add what I bought, then I have what we call goods available for sale. And remember, again, this is all looking in retrospect. I'm looking, for example, over an entire month. Where did I start my inventory? How many purchases did I make during that month? Well, then I would have had, at the end of that month, this amount of goods available for sale. I then get a count of my ending inventory, and I arrive at this number, again, through a physical count. After I've taken that physical count, I can subtract the ending inventory from what I had available, and that would be my cost of goods sold. And so this is the way that the periodic system determines what their cost of goods sold is. And notice again, we only know this after we think about all these items as a period of time, a beginning point, an ending point, and how much I purchased during that, between those 2 points. Now, what does net purchases mean? Well, we start off with gross purchases. And from gross purchases, we'll modify that account by looking at any purchase discounts, discounts we've taken in buying our inventory. We'll look at purchase returns, anything that we've returned, obviously. And then we'll also look at something called freight in, because any amount of money that we spend bringing the inventory to our place of business should be included in the cost of that inventory. And so then you add all those up, or net those items, and that gives me my net purchases. So it is a rather complex system, just in terms of how many accounts are involved. But of course, these are all items that you want to keep track of and could be kept track of in an information system or an Excel spreadsheet rather easily. You know, it's going to put some onus on you as a student to write all this stuff down, to remember it. And again, it's just one of those items where once you start learning how these things work, it really improves and sharpens your accounting intuition. And, you know, I've heard people say, well, just put it into the software, it'll do it for you. But that's never a good way to go about doing anything, because the software isn't always right. And you really need to know what you're doing, what you're entering, how it affects items in an overall inventory system. So these are, of course, 2 equations that you should get familiar with. But if you really think about them, they make sense, right? It's not something you have to memorize. What I start with, what I buy, subtract what I ended up with, must be what I sold. Now, of course, what is the problem with this? That if something was stolen from me, I wouldn't count it in my ending inventory. I would think, therefore, it was sold under a periodic system. Remember, under a perpetual system, we have a check figure, so that when we do this physical count, we can then compare it against, well, what the cost of goods sold was by our physical count, what the cost of goods sold was from our continuously updated perpetual system, and then we can figure out whether there was any shrinkage that went on. So that's one difference, and one thing that arises from the difference between those 2 systems. So now that we have all these terms laid out, you have a whole new amount of counts that you have to keep track of. So we have a purchases account. And remember, I said this was an adjunct asset account. You then have a purchase discount account. This would be a contra asset. You would have a purchase return account. Again, a contra asset. And then you would have a freight in account. That is an adjunct asset. So the way I think of all of this is the purchases account is adjunct to the inventory account. Any amount of purchases increases my overall amount of inventory. The purchase discount, therefore, well, any discounts I take on a purchase should decrease the value of my inventory. Remember, we go by the historical cost principle. If I spent less money to buy my inventory, then I record it at a lower cost, a lower value. So this is a contra account because it would decrease any amount of purchases I made by the discount. Anything I return, of course, is also going to decrease my purchases value. Anything that I spend to bring the inventory to my place of business is going to increase the value because part of the cost of inventory are all expenses taken in order to bring the inventory to my place of business and have it in a saleable condition. So what I have next is just a tabular summary of how the journal entries differ between the two types of systems. Again, note that whenever we make a purchase under the perpetual method, I want to debit the inventory account directly, as I stated, and credit whatever means of payment, be it cash, be it accounts payable. Under the periodic method, I debit the purchases account and then credit again, cash or accounts payable, whatever method I use for payment. When I actually make a sale under the perpetual method, it is a double entry. I have a cash account receivable, whatever was used to pay for the inventory, and then I have the sales revenue. And of course, these two items are recorded at a sale price. And the cost of goods sold in the inventory is, of course, recorded at the cost of inventory. Notice there's only one entry under a periodic system, and that would be the sale. The sales revenue, the cash, and the receivable. We do not update cost of goods sold until the end of the period. Under our perpetual system, an adjusting entry is needed only when the balance of cost of goods sold does not equal the algebraic derivation of cost of goods sold. So remember, that is when we take a physical count of inventory and then we determine by that equation beginning inventory plus purchases less ending inventory gives me the cost of goods sold. Then until I have that distinction, I don't know whether or not I had theft, spoilage, waste, something of that variety. If that does not equal each other, then we have to post a loss on inventory or inventory shrinkage and then credit the inventory for the appropriate amount after the physical count. And so remember, both of these adjusting entries happen after a physical count of inventory. Now, the closing entry for, or the entry to determine cost of goods sold for the period under the periodic method is obviously a bit more complex. Notice it takes each of these nominal accounts, discounts, returns, purchases, freight in, and closes them all out. We credit inventory at its beginning balance. So you think of that as just wiping out any balance you have in the inventory account, and then you debit it by the ending balance, which is again obtained through that physical count of goods. And remember, so then after we close all these out, we're going to get costs of goods sold. That's our plug or our unknown. Another way to represent this journal entry is, of course, the arithmetic equation I had on the prior page. And remember, as I said before, really every journal entry is just a way of expressing an arithmetic equation, right? Don't memorize that huge adjusting entry. You need to really logic your way through it, know which are debit and credit accounts, know how to close them, and it'll be a lot easier, I promise. So, what items are included in inventory? And when I say items, I mean, physically a count of items. When do we record a purchase? When have we bought the inventory? And then when has it been sold? These are questions that can get a little tricky depending on some very particular transactions or ways that inventory is purchased. So when we have goods in transit at the end of the period, we have to carefully consider whether it was an FOB shipping point transaction or an FOB destination transaction. Shipping point means that the title passes when the goods are delivered to the shipper. In other words, any goods in transit still belong to the buyer. I'm sorry, they do belong to the buyer because they have been shipped. Sorry, this is a little bit misleading how I have it worded. Title passes when goods are shipped to the buyer. So if a good is in transit between the seller and the buyer, that means the buyer already technically should record the inventory even though they don't have physical possession. On a destination term, FOB destination, the title only passes when the goods reach their ultimate destination. So we don't record it if it's in transit. If it hasn't reached our loading docks, the buyer doesn't record it, the seller doesn't record the sale. Consigned goods are something that are discussed in Chapter 5, Module 10. And a consigned good is when we do not feel we have the expertise or the market niche to sell an item, and so we turn it over to another party for them to sell it on our behalf. The consignee, the person who we give it to sell on our behalf, they're also sometimes called an agent, does not bear the risk or reward of ownership. They're just making a small commission. They're selling it on behalf of the person who gave it to them to sell, the consignor or the principal. And any good that is on consignment is still legally the possession of the person who is consigning it, who is giving it to the agent. So it is still, the main benefits and risks of ownership are still in the hands of the person who wants it to be sold by another person, right? So those goods stay on our balance sheet, and we do not record a sale when they leave our premises. We do not record a sale until the person we consigned it to makes the sale. And then you can have an arrangement where there's some sort of a special sale contract. For example, a sale with a rate of return. We've already discussed this in Chapter 5 and 7. When we estimate those potential returns, there is an inventory adjustment that has to go hand in hand with the idea that we have estimated how many of these items are going to come back to us. So remember, when the returns can be estimated, we want to make a debit to sales returns, a credit to the allowance for sales returns. But hand in hand with that entry, we also then have to make an entry that will show the estimate of our inventory that is going to come back upon those sales returns. And so I gave an example here where we have a credit sale and we allow our customers a return window of 90 days on merchandise sold. The company made $375,000 of credit sales, and they estimate that 3% of the sales will result in customer returns. Now, I give you additional information about how they price their goods, and I say that they develop their sale price by doing a 40% markup on the cost of their inventory. So that allows you to take the sale revenue and turn it into cost of goods sold. So if they mark up their cost by 40%, then what I'm saying is the cost of goods sold times 1.4 or 140% would give me my sales revenue. And so I just have to solve for cost of goods sold, given that I had sales revenues of $375,000 for the month of January. So solving for cost of goods sold then gives me that this would have been $267,857, and I did round there. But that's the cost of our sales. Now, if I were to estimate that 3% of these sales are going to come back as sales returns, well, then I would take 3% times 375 in order to get a debit to sales returns, a credit to the allowance for sales returns. But in order to determine my inventory adjustment, I would have to multiply 3% by my COGS, because that's the inventory that I'm estimating is going to come back. And so I would debit inventory, and that's just an estimate of the returns that are going to come back. After I multiply that by 3%, I get $8,035.71. And then I would credit cost of goods sold by a similar amount, assuming that anytime I'm debiting inventory, anytime that I credit my inventory account, I debited my cost of goods sold. Well, if some items are coming back then that means that I'm debiting my inventory and crediting my cost of goods sold, just a reversal of that entry in order to determine the appropriate COGS. Right? Bill and hold transactions are a different sort of transaction, again discussed in Chapter 5, Module 10. They're not typically considered sales unless conditions are met to ensure that there's a rationale for it. So if you think of what a bill and hold means, I am a retailer or a manufacturer. I have made a sale, but I am not actually delivering the goods I've sold. I'm billing the person who bought them, but I'm still holding on to the inventory. And so there are certain criteria that have to be met in order to really record this as a sale. Consult Module 10 to see those criteria, but they are rarely considered sales unless all criteria are met. Another interesting transaction is a sale with a buyback. And again, this harkens to what we discussed in the receivable chapter, when there were companies who would sell receivables with an underlying agreement to purchase them back at a slightly higher price. So here we're doing the same thing, except for we're selling inventory. We sell inventory to a party, receive payment, legal title is transferred, but as part of the sale, I'm also agreeing as the seller to buy back the inventory at a higher fixed price at a specified future date. Essentially what I'm doing is getting money now for inventory that I'm not able to move. And so it's a sort of financing with inventory. Because this is just a sale in form, not in substance, we aren't really selling them. We're just repurchasing it in the future, so substance is not there any longer. The inventory remains on the seller's books, and no sales revenue is recorded. So what do we record? Because we receive cash. Well, then we receive the cash, but we connect it to a liability that arises from the contractual provision to repurchase the inventory. So whatever amount we have agreed to repurchase the inventory at, say like at 102% of the sale price, then we record a debit to cash and a credit to a liability account that would make those two items balance. Now, what you're going to have is cash coming in. Say if I did 102% of the sales price, so say I got cash of $100 today, I'm going to have to buy it back at 102, right? 102% of the sales price. Then I would also have a loss that I'd have to record there. All right. So not a sale. What costs do I put in my inventory? Right? So all costs that are traceable to the production of the product, that's going to be from a manufacturer's standpoint. Direct materials, direct labor, manufacturing overhead. Product costs are going to be included as well. They are costs that are directly connected to bringing the goods to the buyer's place of business and converting them to a saleable condition. So any costs that meet those two descriptions should be included. Freight charges, transportation costs on goods purchased, freight in. Right? We've already discussed that account. Adds to the value of my inventory. It's an adjunct account. Any other direct costs of acquisition, insurance costs, anything else you have to put on it, labor and the production costs incurred in processing the goods up to the time of sale. That means I call them some assembly required costs. We might have bought things from a manufacturer, but we have to spruce them up, package them, do whatever we want as the retailer to make them move off our shelves. And so that might include some additional costs. Things we do not include in inventory: selling expenses, general and administrative expenses, interest expense. Those items are not included in the cost of inventory, as you might imagine. So let's look at this example. I say that on January 1st, Kyle Inc. entered a credit purchase agreement with its supplier to buy 12,000 units FOB shipping. Each unit cost Kyle $10, plus a $1.50 per unit shipping fee and a 10-day return window once the merchandise arrives. The inventory arrived at Kyle Inc.'s loading docks on 1/5/16. So if it's shipping point, we still want to record it on we want to record it whenever it was shipped. We don't have to wait until it comes to the loading docks to include it in our inventory. So that's, again, something you want to think about. It's not the end of the period, so it's not quite as crucial, but you always want to keep your eye on that. The inventory arrived at Kyle Inc.'s loading docks on January 5th. They found 140 units were defective, returned them to the supplier. Kyle incurred labor and material costs, 50 cents per unit to get them in a final saleable condition. So in this case, then, we would have a few journal entries to make. I want to look at it under both systems just to give you an idea of how this stuff works under each one. The perpetual system will record things slightly differently than the periodic system. Again, the perpetual system will just really deal directly with the inventory account, whereas the periodic system involves a whole lot of other incidental accounts. So the first item we would be accounting for is the purchase of the goods, and the purchase under the perpetual system would be a debit to the inventory account for the price of those items, 12,000 units at $10 per unit. And since we made the purchase on credit, we would credit our accounts payable. Now, under a periodic system, remember, we do not use the inventory account. Rather, we use a purchases account. We still have paid for this on credit, and so that does not change what I would credit for this item. Freight is another thing that has arisen here. We were charged $1.50 per unit shipping. So $1.50 times 12,000 would give me my ultimate amount of shipping costs. Under a perpetual system, I do not use a freight in account. I would just add this directly to the cost of my inventory. And remember, this is added. We'll assume that we also are paying for freight with an account payable. This is added to the value of my inventory because it is a part of the cost of getting it to my place of business. Under the periodic method, we would separately identify this as freight in. It still will increase my inventory account because remember, the freight in account is an adjunct account, just as is the purchases account. When we make the return, again, under a perpetual method, we return them, we didn't have to pay for them, so we can reduce my account payable by the amount of the returns. I said that 140 units were defective, so 140 times 10 means that I can reduce this by $1,400, and it would also reduce my inventory directly by that amount. Now, under a periodic system, of course, we have a different account for this. It would be purchase returns. This will decrease my inventory account by debiting purchase return. I'm sorry, my mistake, not debiting purchase returns, debiting accounts payable, because we do not have to pay on it. We credit purchase returns. The credit to purchase returns is a contra account. It reduces my amount of purchases and inventory, and so crediting that account will adjust it down. And now notice I caught myself in the mistake because while I was describing it, I realized, oh no, if I debited purchase returns, that would actually increase my inventory. It's a contra account, it's a credit balance. In order to decrease my inventory, I have to credit it. And so that's why that narrative is so important, because it'll help you not make a mistake, just like I almost made that mistake, right? Now, finally, we're going to look at that they incurred labor and material cost of 50 cents per unit to get them in a final sellable condition. So this is that some assembly required costs, but so we just are going to call that additional costs to prepare the inventory, because remember, it's all about getting it to our place of business and in a final sellable condition. So in this case, we only have, we had 1,200 units, we returned 140, so we're only going to be doing these additional costs on 11,860 of our inventory items, and that's 50 cents per. So that comes out to, again, that would be a cost I'd include in my inventory. I debit the inventory account directly under the perpetual system, and then I would credit cash or whatever, maybe an account payable. The credit doesn't matter to me that much as you're understanding that where this is going in terms of the inventory account or a different adjunct account. Here, when we make this improvement, we would make the improvement to the purchases account. And again, whether we paid cash or credit, this seems a little bit more likely cash because this is an internal cost of assembling the inventory in some way. So that's how those two items would differ under a perpetual and a periodic method. So now let's talk about the treatment of purchase discounts. Purchase discounts, we talked about these in a receivable standpoint. And from the receivable standpoint, we were talking about the perspective of the seller. Well, now we're on the other side of this transaction. We're talking about purchasing an item and getting a discount from that purchase amount. So it's the same sort of procedure, the same accounting methods, slightly different accounting names, but again, the symmetry persists. If we look at the gross method, we record the purchase at the gross amount, and then if a discount is taken, well, we recorded this at 100%, therefore, when we debit it and someone pays us within the discount window, we're debiting the 100% amount. However, we're only getting cash for the net of discount amount, in this case, $980. In order to get this to balance, then I have to credit the purchase discount account by $20 to make everything correct. Now, if they don't use the discount, using the gross method, we assume they wouldn't, 100% cost, then we can just collect the 100% price, debit accounts payable by 100%. For the net method, again, the same logic holds from last time. We record these items at their net of discount price. Therefore, if the customer acts within the discount window, there's no special accounting involved. If the customer fails to act, or I'm sorry, we, not the customer, because we are the customer in this case. If we fail to act within the discount window, then we have to increase the amount of the payable because we recorded the payable, the liability at $980 when we're paying $1,000 of cash. And then instead of interest revenue, as the seller recorded, we would record interest expense because in essence, someone gave us inventory and allowed us to pay later. The fact that we paid later and missed a discount now has accrued interest expense. So let's now again look at that same Kyle example, but assume some sort of a discount was going on. Now I say assume the same facts as we did in Kyle. In addition, the supplier gave Kyle Inc. Discount terms of 3, 10, and 30, so a 3% discount if paid within 10 days, a full discount if they wait, but it's due in 30 days. So let's look at what it would look like under the perpetual and the periodic methods. So under a periodic method, remember we had 11,860 units that we kept because we just returned the defective units. There wouldn't be a discount on those defective units. We would just record the full credit to the account payable. Now, if I record the item under the gross method using the periodic system, then I would have an account payable of the full price. That was $10 per unit. And so the 11,860 times $10 gives me the full price amount. Now, if I act within the discount window, then I only have to pay cash equal to 98% of that amount because I'm getting a 2% discount. Well, that's going to give me cash of $115,042. So then I would record a purchase discount to account for the difference between those two of $3,558. Now, under a perpetual system, remember, we don't use that discount, that purchase discount account. So how do we record it? Then it's the same entry, account payable, cash, the account payable for $118,600, cash for $115,042. But rather than crediting a purchase discount, we just credit the value of the inventory directly because any discounts we get mean that we pay less than the amount that's in the inventory account, and therefore we reduce it by that discount. We just lose the actual amount of the discount. It just looks like inventory left. So that's the first video on this. It sets up a lot of important ideas about how to record an inventory system, perpetual and periodic. The next thing we're going to get into is a more calculation-based determination of using different cost flow assumptions, FIFO, LIFO, average weighted cost. You're going to have to use all these ideas in calculating those things, and you're going to see that you really need to nail this stuff down before you get to the next stuff. So make sure you understand these entries. Make sure you understand the difference between a perpetual method system and a periodic system and how the accounts interrelate.